In this segment, we'll preview next week's biggest business and economic stories. On Monday, the Japanese Finance Ministry will release its latest reading for the current account, a key gauge of Japan's trade and investment with the rest of the world. On Wednesday, the U.S. Labor Department will publish the Consumer Price Index for January. And on Friday, the European Single Currency Bloc will disclose a flash estimate of its GDP for the October to December period. In the BizPix feature this week, we decipher Japan's current account data. The country posted a record current account surplus for the month of November, extending its surplus streak to 22 months in a row. Karakama Daisuke, chief market economist at Mizuho Bank, says the annual figure for 2024 will be a record high. That's certain.
The annual current account surplus already hit a record high as of November, reaching almost 30 trillion yen. The previous record, set in 2007, was about 25 trillion yen, so the total after 11 months of 2024 already exceeds that.
A major driver of that result was corporate earnings from foreign bond holdings and dividends, known as the primary income surplus. This income has been boosted by the weaker yen and high international interest rates. But Karakama says Japan's economy is not enjoying the benefits you'd expect from such a massive surplus.
Japanese firms tend to keep earnings in local currencies as their internal reserves for the next periods, instead of investing them in Japan. They reinvest interest from US government bonds, for instance, without exchanging to yen to gain compound interest. Those surpluses on the books, called the primary income surpluses, are not returned to Japan. It's risky to believe Japan's economy is in good shape because of the size of the surpluses.
The record high travel account surplus in 2024 also looks good on paper. It topped 5 trillion yen due to strong demand from inbound tourism. But Karakama says worker shortages and over-tourism could soon put a ceiling on this revenue. Another worry for the economy is low competitiveness in digital technology. Japan is continuing to pay for overseas digital services, expanding the digital deficit year after year.
The digital deficit stood at 5.5 trillion yen in 2023. I think it will be around 7 trillion in 2024. The deficit is increasing at an annual pace of roughly 10 to 13%. So if 2024 has a 7 trillion yen deficit, 2025 would see 10% more, nearly 8 trillion yen. We can't imagine that we'll stop using digital services in the future. This means that the digital deficit will grow surely and steadily, and the inbound tourism growth is hitting a ceiling. Overall, we are likely to see the service account deficit expand, pushed up by the digital deficit.
Karakama estimates Japan's service deficit will exceed 10 trillion yen sometime between 2030 and 2035, given that overseas digital platforms are raising their fees every year. I'm John Ledoux, and that wraps it up for this week's BizPix.